Hello, everybody. Welcome to another episode of the Olympus Wealth Strategies podcast. I'm your host, John Sidery, where we help you take your finances to great heights. I'm very thankful to have a special guest on the podcast today to help decipher a lot of questions that we've had roll in and a lot of maybe misconception that's out there. Very thankful to have Dani Beavers, who's a CPA, also my colleague on the podcast. And so, Dani, how about you go ahead and just tell us a little about yourself?
Yes, sir. I am a CPA. I was the first CPA hired for holistic planning. Also Uptick Partners, so we're mutually owned. And I was hired in the fall of 23. The fall of 23. I'm getting my years mixed up. So they broke away from Edward Jones Holistic Planning did in March of 23. And then I was brought on in that fall. So, a long game plan of Steve Barber's was to hire a CPA to do tax practice with his clients, with his investment clients. And I kind of got to be the first person to do that and bring that dream of his to life. So Steve and I have a really great relationship, have really built a really strong bond because he has this huge passion for tax planning and I've got to be a big part of making that dream come true. Just with my license, with my background, and got to be a big part of that. So it's been awesome. We have brought on several tax clients that had originally been their investment clients and kind of brought them in, started doing their returns here in-house, doing their tax planning. So I'm in a lot of those wealth management meetings with the advisors and giving tax advice, tax planning right there alongside them. And then obviously after the year's over, doing those returns for clients. So all in one place, doing it all in-house has been an awesome experience. Aside from that, obviously, I graduated from Stephen F. Austin State University, which is here in Nacogdoches, which is where we're located. And I got my master's in accounting. From there, went on to go into public accounting, then moved out of public accounting into industry, and then made my way back to tax. So I kind of have a little bit of background everywhere. When I was in public accounting, I was doing internal audit. I have experience in oil and gas, in the cooperative industries, and then obviously my tax experience. So a plethora of kind of different avenues. But aside from that, I'm a mom. I have a 2.5-year-old, hope to have more kids. Married to a football and basketball coach. So sports is a huge part of my life, coming from somebody that has literally never played a sport in my life. It occupies most of my evenings and weekends. So that's kind of me as a summary. Do you have any questions?
Well, you obviously stay really busy. I can appreciate you going to all those games. I have a good friend who's an athletic director, and their family are always at various events. So kudos to you for the balancing your schedule and your time. But Dani is a huge help to Uptick clients. And so, Dani, if you can help us with some of these questions that rolled in, especially as it pertains to maybe how investments and tax are so blended together. One of the questions we had was, what's the difference between tax preparation and tax planning, and why should people actually care about both?
So I think it goes both ways as far as people forgetting to care about both. Whereas a lot of individuals are just thinking about their tax preparation. It's more of just something they have to check off their to-do list every year. And then a lot of advisors only focus on tax planning. The ones that do think about tax planning, that's all they think about. So being able to do both in one place has been crazy. Just the success that we've had for our clients because we can do both. But the difference is, you'll hear this analogy over and over, but one is driving the car, right? Tax planning is, where do we want to go? What's the future? Where are we headed? What can we do to get there? The other is just saying, hey, what did happen? What's in the rearview mirror? And that's an analogy that we hear all the time. But I think a lot of it is, what's that quote? The failing to plan is planning to fail. There's so many situations where somebody will come to us and we're looking at their return, and you can tell within a matter of 2-3 minutes that they missed this opportunity, they missed that opportunity, and things you can't come back and do. Now, obviously, there are some things you can do after the end of the year, but more than anything, a lot of these things you have to do ahead of time. I just worked with a client which I know we'll talk about this later, but they were setting up an S Corp. We had to do that. They came to us, became a client in the fall. We had to set up the S Corp for 2025. In January is when we did it, so that we could do this whole picture. But we had to just do their 24 return, not as an S Corp, not taking advantage of all those opportunities, because they hadn't been somewhere that had told them to do that. They hadn't been somewhere to plan. And it wasn't like they had a big career switch. Just nobody had mentioned it to them. Nobody had brought it up.
Well, and it just really sounds like, Dani, from what you described, is one seems to be more, like you said, kind of check the box and reactionary, which I would kind of say tax preparation is that way. Whereas tax planning truly is being proactive and looking for opportunities throughout the whole year to be able to, once you get to the preparation stage, you have, like you said, you have prepared yourself and you kind of know not only where you stand, but also the opportunities that you're able to capture along the way.
Yes. And I think a lot of it is why that's not happening in a ton of CPA firms and a ton of tax practices is not from a lack of knowledge. There are much wiser CPAs out there than me, right? I'm not claiming to be the smartest or the best CPA in the world. But it's a lack of communication with your clients. We have this advantage of most of our clients have 2 meetings a year with us. So they're in our office sitting here and we just know what's going on with them. So we know what to suggest and what to plan. Whereas a lot of tax preparers, they meet one time a year and it's when you sign your return. It's just too late. And, and they do tax planning, but it's, it has to be more at the effort of the client. They have to go ask, hey, can we set up a meeting because I have this, and this question. A lot of these people, especially people that aren't business owners or just your normal, everyday, tax client, they don't even know what questions they're supposed to be asking. So how can they know that they need to go out of their way to set up a meeting with their CPA when they don't even know? I'm trying to think about examples like, I have a client that they're fully retired, but they do some small part-time work. Well, they're contributing to an IRA every year. They didn't even know that they needed to ask that question. We just know from knowing them and them being here, for an hour-long meeting twice a year, like, hey, aren't y'all doing some part-time work? Well, have y'all considered contributing to an IRA? Because you have that opportunity. And I don't think, I guess I hear a lot of things of people just kind of speaking down to CPAs in the practice because they're like, they're not even planning for the future. They're not supporting their clients. And obviously it's my background. It's where I come from. So I have a little bit of struggle to be like, yeah, CPAs, they're the worst. Because I don't think that it's from lack of knowledge or lack of caring about their clients. It's just not how they're set up.
Well, and like you said, it's that structure, right? It's the ability to have the bandwidth in your day, like you just mentioned, to sit down with a lot of upticks clients, multiple times a year and provide that guidance and planning and, to the client's end or even to all of us, right? Because we're all not, masters of everything. We don't know what we don't know.
Right.
But it's ultimately you lean on the professional that you're working with to kind of be that guide for you. And so, Dani, kind of in that same vein, what would you say one of the biggest misconceptions people have about tax planning? Would it be just they don't know to sit down with their CPA and ask those questions?
Yeah, I think that they just don't even know that there's an option. They think that any kind of tax planning or tax strategy is set aside for this mega wealthy group of people, or, these extremely high earners, which is just completely untrue. And there's a ton of tax planning that, that everyone should be doing and should be made aware of. And I think there's just this very common thought in the back of people's heads. It's like, I don't make enough money for that. This doesn't apply to me because none of these strategies could work for me because I'm not going to open a donor advised fund and contribute $1 million. So I just shouldn't do anything. I think that's probably the biggest misconception, or that it's too complicated, that I'm going to have to do so much work to save $1,000. And they're like, it's just, they think maybe it's not enough of a value there for the amount of work. And a lot of it is just, there might be a little bit upfront work from the client's perspective of getting something set up or getting something going, but it's not this huge time consuming task. If you have the right team, if you have people supporting you and helping you, it's not something that should be, taking over your life. It should just be something you think about throughout the year, but, you think about it, you think about all your finances throughout the year, or you should be. So
yeah,
it shouldn't be this huge undertaking. If you have,
or at least your team should be structured that way to be helping you think about it holistically
Correct.
Throughout the year.
Correct.
So kind of in that same vein, Dani, you mentioned just a second ago how people kind of have this thought, well, hey, it may not apply to me, so I'm not going to really go down the rabbit hole. So when you look at returns, I know this is so case by case basis, but for all the of our clients that you help, is there kind of a common theme for, call it your average everyday American worker, that there might be some more common missed deductions or credits that could actually start to move the needle and make a difference for them?
A lot of the credits, deductions are going to be things that are more automatically done. If you're not going to miss your child tax credit, it's any preparer. If you prepare your own return on TurboTax, you're going to get that. I think there's a lot of missed opportunities in contributing to IRAs. A lot of people think, if you're married, your spouse can contribute even if they're not working. A lot of people don't know that. I've told friends and family that, and they're like, well, no, I can't. I don't have earned income. Let your spouse has earned income. You can still contribute. I think that's a huge one. HSAs are a huge ticket item to me that I will tell anybody that will listen to me, friends, family, whatever, at like a barbecue. You should have an HSA, and you need, of course, you have to have the correct kind of health insurance to have one. But don't quote me on these numbers, but it's something like 40% of working Americans have health insurance plans that could have an HSA, and only like 30% of those people actually have one. Only another fraction, like another 30% of those people are actually contributing and using them. So it's super underutilized, and there are just so many benefits to it. Like I said, I'll talk about HSAs for a whole hour.
I'll stand on the soapbox with you and
Yes.
preach about them and say how it's, I've got the CPA with me now, but how it's the most tax efficient dollars you can contribute. But
most.
They're a wonderful tool.
The only other thing that I can kind of think of in that vein, which I don't think is exactly the question, but is this idea of getting back a big refund. People love to get their refunds. And of course, the years that I have gotten a refund, it's fun. It's way more fun than paying in. I know that. But just, I'll see clients, they come to us for the first year and they're getting back these like $15,000 $9,000-$10,000 refunds, and you're, why? You just let the government borrow.
Tax-free loan to the government, right?
Yeah, you let them borrow your money for what reason? And a lot of these people are people that are good at managing their money. It's not like if they didn't let the government borrow it, they wouldn't save it. They're not. They're just. It's just a lack of planning, So it's something we talk about our clients a lot is like, bring me your W-4. Like, let's fill it out together. Let's talk about what your W-4 actually needs to look like to fix this. Because that's usually going to be our biggest people that pay in too much, or just people that are just W-2 income, and they fill out their W-4 when they started and they never checked up, or they don't know how to fix it to make it withhold less.
Right. That's very important. You kind of alluded to this a little earlier with, people either doing it themselves or TurboTax or working with a CPA or thinking they may not need to seek a robust CPA experience because of kind of their, call it just standard average American, which is W-2 compensation and just household income. But when would be the right time for someone to start working with a CPA? And what do you think, obviously having sat in many different roles in your career, what should they expect from that relationship?
So obviously the sooner the better. Right now, if you have the ability, I think a good CPA can always help you. But I think what they can expect from that relationship, what they can expect and what they should, what they deserve are probably different. But I think when you're looking for a good CPA, when you're looking for somebody that you want to kind of partner with for your life and help you strategize, truly help take care of you, you need to look for somebody that is going to explain your return to you. I think a lot of even my clients, people that I tell all the time, like, I'm here for you. I'm here to sit and listen to you. They feel guilty digging into the nitty-gritty of their return, almost like if they ask questions about their return, I'm going to think they don't trust me. Where has that like seed been planted? I don't know. But they deserve to, if they want to sit with me and go through line by line their return, they deserve that. They deserve to know where their hard-earned dollars are going and where they came from. And it's something I'm very passionate about. I'll ask clients that'll come in and I'll say, God, we got to get you set up with some estimated tax payments because last year you paid the government $600 in interest and penalties. And they'll say, no, I didn't. You sure did. Look right here on this second page of your 1040. There's a line. You paid that and you signed off on your return and your CPA signed off on your return. They just didn't talk to you about it. And you didn't ask because maybe you felt like you shouldn't. Maybe you didn't understand the return enough to talk through it. You deserve to understand your return, and you are paying somebody your hard-earned dollars to do the return and to explain it to you. There are always going to be clients that don't care. They don't want to know. They're like, just tell me the end dollar and I want to go home. And that's fine. But if you do care, which you should, you deserve to know it. I think a good CPA is going to be somebody that's thinking proactive, that's talking to you well before the year's over, not just in February when you hand in your documents. So I think those are the two biggest things. Look for somebody that's going to be proactive, and look for somebody that cares about you enough to take the time to answer all of your questions and to make you not feel like an idiot for asking them.
Yeah. And hey, it's our job. We're blessed to be in our seats, right? And it's our job to be educators when there's questions, or ultimately try to anticipate what those questions might be.
Yes. Yes. Try to be like, you didn't ask this, but you should. Let me ask it for you. Yes.
Yeah. Always one of those, what should I be asking, right?
Yes.
Let's transition for a second, Dani. For business owners, I know this is very, very broad, but One of the questions we have is, what are a few key tax strategies for business owners that an entrepreneur or small business should be thinking about throughout the year and not just when they go to file?
So obviously, we kind of touched on this earlier. How is your entity structured? Are you an LLC? Are you an S corp? And what's the most beneficial to you? Because I think that a lot of people are like, they just love S corps, and they're like, S corps are the best. We all need to be an S corp, and that's not always true. It's not always what's best for you. It is a lot of times, and we love S corps. We set a lot of our clients up like that, and they'll be LLCs taxed as an S corp, so they're still running everything through their Schedule C. They're still, they don't have to file a business return. So I think first and foremost, it's how's your entity structured, and do you like it? Is it the most beneficial for you? And then obviously all the different retirement planning you can do. What's the best for you? Can we do a SEP? Can we do a solo K? Can we, what are those options? And planning for them strategically. If you're going to go the S corp route, what is a reasonable salary to pay yourself? And make sure you're documenting that. Where did you come up with this reasonable salary? People love to just be like, it's $100,000 because that sounds safe and fun. But you need to justify where this reasonable salary came from. And you need to be thinking about that throughout the year because, I'm thinking about the client that I was telling you earlier that they weren't an S corp when they came on, and now they are. And if you just said, well, we'll pay ourselves a reasonable salary, that's going to change all your numbers, and we need to discuss what is a reasonable salary for your current role and plug that into our full financial picture for your tax year. Obviously, depreciation is huge. Think through, do you want to do bonus depreciation, 179, any of those things to try to bring your tax picture down? Is it most beneficial for you? Is it better to spread it out? And that's going to be something, all of those little strategies are very different per person, right? Which all of it is. I could say that in any of these questions. But I think specifically when it comes to business, it's like, what is your business goals? Where are you headed? When you're talking about depreciation, do you want to spread it out as long as you possibly can? Because this year you don't have much income, but you're going to in the future, and you want that depreciation in the future years. Because again, people love to be like, let's take all of this bonus depreciation right up front because we want a low tax bill this year. Of course you do. You also want a low tax bill overall for the lifetime of your life and your business.
That's right.
Think about this year. Think about, this year you get $1,000 of income. Next year you're going to have 100,000. Wouldn't you rather have depreciation then? Got to think a little bit more in the future.
Well, that's some good advice. So, this was the most requested, or the most requested question, if that's the right way to say it. What are some red flags that might trigger an IRS audit, and what can either individuals and or business owners do to avoid them outside of working with you?
Big red flags are going to be just missed income, right? Missing a 1099, missing anything like that, a K1. Those will be crazy situations. People don't even know they're getting K1s, and they're like, oh, wait. Missing all of those things are probably really big because it's low-hanging fruit for the IRS. They're getting a copy of that 1099, and they're saying, wait, why did no one ever report this? So making sure that you know what you have going on, or that your CPA knows what you have going on, checking for those. We run all of our clients through... it's a program that kind of is like a backdoor to the IRS. So we see all the 1099s that the IRS gets for our tax clients. So it's never fun to be like, hey, you forgot to give me a 1099, so I'm going to include it on your return, assuming I'm going to check with them. that was a valid 1099. You were supposed to receive it. It's never super fun because it's more income they have to now report, but you would rather report it than get pulled for an audit and have all that interest and penalties tacked on. So I think, knowing what documents you're expecting to get and making sure that you do receive each and every one of them. Record keeping. That's probably the biggest, most important thing is document everything, keep your records, hold on to them. I like to digitize everything because I don't want to have it all scattered about. Scan it, save it, whatever you need to do. Hold on to it. And then I think just not being terrified. There are people that are pulled for 100% just random audits. It does not mean that you have done something wrong and they think you've done something wrong. They're just pulling you to see, did you? What is everything good? Steve Barber tells one of the funniest stories that he got pulled for an audit. He went through all this work, just before a lot of cloud-based storage and all of this. So he's, scanning receipts, he's making copies, he's doing this whole thing, and came out that they actually owed him money, that he had forgotten. I'm going to forget which credit or deduction or something it was. He had forgotten something on his return and ended up getting like a few $100s back. So he's like,
best audit ever.
Yeah, it's great. He then, they pulled the next year too. So maybe he shouldn't have those. No, but it's not always scary. It's not always this horrible thing. Find a good team, somebody to work with you to help you through it. But as long as you've kept your records and you're being honest and doing your due diligence, you're going to be fine.
So this next question, Dani, maybe we can tie this into the whole genesis of how you have come to work with Uptick clients is the question was, how can proactive tax planning tie into someone's broader financial or retirement strategy? Or maybe kind of said differently, why did Uptick decide to incorporate tax preparation and planning and having someone like yourself in-house? Why is that so important today?
I think it's important for obviously several reasons, but I think looking at everything, and we mentioned this earlier, on a lifetime basis and longer than your lifetime, thinking about your kids' lifetimes and this more big picture. I think that having somebody that's in-house working with you, you're able to think of it on a broader spectrum and really dive into the nitty-gritty, to the little things. I'm thinking about a client example, and I'll just give a million examples. But, we had a client, she's, a mother, she has 2 kids, and she's sitting here in like the 12% tax bracket. She has both of her kids that I think one's in like the 32% bracket. The daughter is probably also in the 32, but she lives out of state, has state income tax, right? This lady has a huge traditional IRA that her kids are going to inherit. And I was able to sit in that meeting with her daughter and with her and talk about not only, number one, 12% is cheap tax, you should be converting your money regardless, but how much cheaper you're getting this money converted than your daughter would be able to. I think her overall tax rate was over 40% once you looked at state. Just, significantly different. So being able to sit there, multiple generations, and talk about, let's go ahead and convert this money. Your kids are going to get less money from you, but they're going to get more money in their pocket at the end of the day. So I think those types of conversations is, why I'm here. And That was like a 4-hour meeting that day. It was crazy. But we did just amazing things for this family. And, you know, at the end of the day, you're keeping more money in your pocket or your kids' pockets. You're keeping more money for your family and less to the government, which I think we can all appreciate at the end of the day.
And clients obviously value you, so they don't have to play middleman, right? Between their investment advisor and their accountant. And then on top of that, if their accountant in the public accounting world is structured to even have that time to sit down like you just did and have a 4-hour meeting with this family to make a generational impact, if they even have that ability to do so, given, you know, the umbrella that they're under.
Yep.
We kind of touched on this a little bit, but maybe if we're going to think about high income earners, is there a common mistake you see high income earners make, and ultimately is there an easy way that they can avoid that?
I think when you're specifically talking about high income earners, it's not this lack of knowledge. It's not this, most of them even is not a lack of having a good team. They know there's good teams out there. A lot of these high income earners are people that are comfortable with technology, and they know they can go out and get a team anywhere in the country that will work with them. And obviously that's a huge part of it, but they let their busyness of their lives just stop them from doing it. Don't let your busyness, don't let the fact that you are probably at the height of your career, you're probably drowning at work. Don't let that be the reason that you miss out on these huge opportunities, and don't set your family up for success. I think that would probably be my biggest. Make the time for it. Set aside the time and do it. Because there's a lot of people, they max their 401ks and they think, that's all I can do, I'm done. And it's easy because you just pull it out of your paycheck and you're done. And they're not taking advantage of the things like the HSAs or setting their kids up, with 529s, or, just setting up regular brokerage accounts. That's a huge thing. Just invest your money, even if it's not tax advantage, which is probably not something that a lot of people think they would hear me say. But it's very hard when you're sitting in a meeting and you see somebody that's been this high income earner. They have this huge traditional IRA and that's all they have. Great. I'm so glad that you saved for retirement. You were miles ahead of tons of other people, but it's a much better feeling when you're sitting there and you're like, okay, you have some of your money already in Roth. You have a traditional IRA, and then you have this after-tax bucket that you can, you can pay the tax bill to do your Roth conversions, or you can kind of make your whole financial picture better by being able to pull out of these different buckets. And it gives us a lot of different levers to pull to make your tax picture work well into your retirement. So I think that a lot of people kind of just stop at the 401k level and they're like, what? I maxed my 401k. Look at me. I'm doing great. And you are. Don't let me tell you that that's not enough. That's amazing. But if you have the opportunity and you have the funds to do so, don't stop there.
Absolutely. And kind of like you said earlier, right? People should care about where their money's going, just like we all care about how much we're going to spend on vacation or how much we're going to go spend to go out to eat tonight with our family. We should care enough to know what opportunities am I missing out on, or what opportunities could I better maximize to make my dollars more efficient for me.
Yeah, 100%. And not just thinking of it like what is best today. What is going to be best in retirement? What's going to be best 20 years from now? That goes back to, the classic of contributing to traditional IRA versus your Roth. Yeah, it's great if you contribute to a traditional 401k and you lower your tax picture this year. That's awesome. But what's going to be most beneficial for you 20, 30, 40 years from now? And that,
And the flexibility that provides.
Yeah, exactly.
Absolutely. So, Dani, with the recent tax legislation that got passed through the big, beautiful bill, Are there any tax law changes or trends that individuals or businesses should be preparing for now with that new legislation on the books?
It's interesting. I've done 2 trainings on it the past week or so, and obviously we're still learning a lot, so asking a lot of questions. For our clients specifically, we have a lot of elderly clients and a lot of people that are benefiting from that additional $6,000 credit. And I'm very interested to see how this is going to affect our strategizing and our planning for these clients. We were looking at some of these the other day, kind of their tax picture for the year. And normally somebody that we would recommend they do Roth conversions, when they started doing Roth conversions, they started losing that credit. And it's last year you would have done them. You would have done them at the same tax rate and you would have been happy. But now all of a sudden knowing that $6,000 credit's on the table and you could lose it. You weren't going to get it at all last year and you were fine with that. But now it is an option. But if you do the Roth conversion, I'm not saying everybody doing Roth conversions is going to lose that credit. But with this specific client, it was like it put them over that income limit and it started reducing their credit. So the actual effective rate of doing their Roth conversion it was higher because you're losing that credit. I don't know if I'm doing a good job of explaining that situation. But
no, that's perfect. It obviously creates another element to plan for and just highlights the reason that people need to work with a proactive qualified CPA.
Right. And losing that credit
because
might
something like that, right? You could just think, hey, I'm going to just do this Roth conversion like I did last year. But maybe when they sit down with you and you run the numbers and you go, maybe it doesn't financially make sense this year.
Right. And that's exactly where we ended with this person. We did a much smaller conversion than we probably would have done before this passed. So I think that's a huge part, is just kind of working through all of these little changes and saying, a lot of it's going to be great for our clients. Overall, I'm seeing awesome things. I think don't be fooled by it's permanent. A lot of these changes are temporary, but a lot of them are kind of being marketed is probably not the correct term, but kind of being sold as we make permanent tax changes.
Subject to change for every administration, right?
There you go. And you're like,
yeah.
How permanent are they? So I think don't be fooled by that word. Don't be fooled by it's permanent. Take advantage of these reduced rates because you know that historically 12%, 22% is cheap. You're getting out the door with 78% of your money or 88% of your money, whatever your rate is. But overall, that's pretty cheap. If you go back historically and you look at it. So don't think, well, the rates are cheap and they're going to be forever because they say it's permanent. I would, just be cautious of that. And then I've had a lot of clients say, well, shouldn't we wait because Social Security is going to stop being taxed? That's been a huge question. I wouldn't hold my breath. I wouldn't stop making any decisions in hopes that, well, here in a few years, my Social Security is not going to be taxed, so I'm going to do Roth conversions then. I'm very big on look at what the tax code is saying today. Look at what's our options and ask ourselves, we always make the kind of the analogy of it's a game of deal or no deal. I can get out my effective rate at 20%. Deal or no deal. Are you okay with that right now? Make that, you have to kind of look at, will I look back in 20 years and say, if I would have just waited a few years, I could have got that money at 15%. Maybe, but
you know what you had today, right? And that's just like their investment portfolio.
Yeah.
Whether we make a tactical decision or not, it's that was the best decision with the information that we had in the moment.
Right. And So I don't want people to get caught up in this is all so great and it's going to be like this forever. Because we all know that it's all subject to change. And, maybe I'm cynical, but.
Well, history tells us that tax rates are historically cheap and that tax policy changes frequently.
Yep. But, it keeps me busy. I got to, keep up with all the changes. So it's fun.
Well, Dani, is there anything that you want to leave our listeners with?
I think my biggest takeaway that I want people to have is don't settle. Don't settle for subpar, wealth management. Don't settle for subpar tax planning. That there are good people out there that understand the code and that want to talk to you and want to work with you. And make sure you find them. If that's us, great. If it's somebody else, that's awesome. But know that the amount of people that I talk to that can't even tell me what their current tax rate is, how much income tax they're even giving to the government. They have no clue. They do their return every year and they know what their refund was and they go about their lives. Don't settle for that. The tax code's complicated. Like you said, it's changing all the time. They love to change it. But don't feel like I'm not a tax professional. I don't know what's going on. So I just won't. I'll just throw up my hands and I'll just pay what they tell me to pay. Ask the questions. Don't be afraid of looking dumb or looking silly. There's a ton of people out there that don't understand it. And you deserve to. You deserve to know how much tax you're paying. And find somebody that will help you understand that. I think that would be my biggest takeaway.
Well, that's great. Well, Dani, really appreciate obviously your time and insight that you share with us today and for all the wonderful work you do for the Uptick Communities clients. And we're looking forward to hopefully having you on the podcast again to break down some more questions.
Yes, sir. I've enjoyed it. Thank you for having me.
Thank you so much, everybody, for tuning in to this episode. And we're looking forward to seeing you on the next one.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.